Welcome to the Deep Dive. Today we're exploring decentralized finance, DeFi. It's basically this financial system built using blockchain and, well, smart contract technology. You've shared some really fascinating material, and I think our goal today is to really dig into how yield generation actually works in DeFi.
Yeah, that's the core of it.
And also the key metrics,
Yeah.
how to evaluate these opportunities, and maybe touch on some of the emerging trends too.
Exactly. We're going to sort of trace the evolution of these ideas. It actually starts even before Bitcoin, which is interesting.
Oh, really?
Yeah, and then look at the foundational innovations that really shaped DeFi into what we see today. Then we'll dive into those metrics and the key trends you mentioned.
Okay, let's start right there then, at the beginning. Because you're saying the seeds for DeFi were sown like way before Bitcoin popped up in 2009.
Absolutely. The intellectual groundwork, it goes back decades. Nick Szabo, for instance, he conceptualized smart contracts. Get this, back in 1996.
96, wow. Before blockchain was even a thing, really.
Exactly. His idea was computerized transaction protocols that execute the terms of a contract automatically. Just think about that for a second. Imagining these self-executing digital agreements before the tech to fully make them happen even existed. Szabo saw the potential. He realized you could dramatically cut down on fraud and the costs involved in enforcing contracts. That's a core idea that really echoes in DeFi today, this whole trust-minimized environment.
So this vision, this idea of self-running contracts was already floating around back then. What else was happening in that sort of pre-Bitcoin era that paved the way?
Oh, it's a really fascinating period. You had, well, fundamental stuff like TCP/IP in 74, the internet's backbone, right? Then RSA encryption in 78, a massive leap in cryptography, enabling public key systems. David Chaum's work in the early 80s, super important for digital privacy concepts. Things like untraceable email, blind signatures.
Stuff that's still relevant in crypto discussions today.
Yeah, totally. And then the early 90s, you get the cyberpunk movement. They were actively pushing for tech that boosts individual privacy. And alongside that, these early experiments in digital money.
Ah, yeah, I've heard of some of those.
DigiCash in 89, CyberCash 94, eGold 96. I mean, they didn't hit the mainstream, obviously, but they were crucial experiments, learning experiences.
Advancing the waters.
Exactly. Then Adam Back invents proof of work in 97, which is key for Bitcoin later. And Szabo even came up with BitGold in 98.
It really sounds like there was this underlying current building up, a sort of desire for digital privacy, maybe alternative financial systems, even if the tech wasn't quite there yet.
Precisely. You see this consistent thread right through the late 20th century. People chasing digital privacy, secure communication, self-enforcing agreements online, Chaum's work, Szabo's smart contracts. These weren't just tech novelties. They represented something deeper, a desire for a more, trustless and private digital world. And that's the desire that Bitcoin and then DeFi really tapped into. All these breakthroughs in crypto, computer science, digital privacy, they created this fertile ground. And then, boom, the 2008 financial crisis, Lehman Brothers collapsing.
That definitely amplified things.
Well, yeah. It really fueled the demand for more decentralized, more transparent financial options. So this rich prehistory, it's absolutely key to understanding why Bitcoin emerged and why DeFi took the shape it did. Bitcoin really stood on the shoulders of all that earlier work.
Okay, so Bitcoin lays that foundation, decentralized digital currency. But the DeFi landscape we kind of recognize now, that really kicked off after Bitcoin with specific innovations, right? Ethereum seems huge there.
Oh, absolutely. Ethereum was a watershed moment, no question. Bitcoin showed, decentralized digital cash is possible. But Ethereum, launching in 2015, it unlocked the potential for building complex financial applications on a blockchain.
Right, the smart contract.
Exactly. It brought Szabo's 1996 vision roaring to life, but at scale. Suddenly, developers weren't just sending currency. They could create and deploy these self-executing agreements, build entire decentralized applications, dApps.
And that's when we started seeing actual DeFi applications take off. What were some of the early ones that got people's attention?
Yeah, things started moving fast. We saw MakerDAO emerge in 2017. They introduced the DAI stablecoin.
DAI, still
Good
big
one. Still huge. And what was so innovative then was how it kept its peg to the dollar. It used smart contracts and these collateralized debt positions, a totally novel way to make a stable digital currency on-chain.
Okay.
Also, back in 2015, Fabian Vogelsteller proposed the ERC20 standard on Ethereum. That made it incredibly easy for basically anyone to create their own token on Ethereum.
Right, this token explosion.
Exactly, the ability to easily tokenize assets. That became a cornerstone of DeFi. Then, 2016, you get EtherDelta, one of the very first decentralized exchanges, or DEXs.
There's no central company holding the keys.
Precisely. Instead of a central company holding funds and matching trades, EtherDelta used an on-chain order book. People could trade those new ERC20 tokens directly, peer-to-peer.
Okay.
And of course, we absolutely have to talk about the rise of automated market makers, AMMs.
Right. Big shift from order books.
Huge shift. Instead of matching buy and sell orders, AMMs use this elegant concept. The price of an asset just changes based on how much of it is in a liquidity pool. Simple supply and demand, automated by an algorithm.
More of A, less of B, so B gets pricier.
You got it. That innovation was absolutely crucial for providing liquidity in a decentralized way. It really, really fueled DeFi's growth.
Okay, so we've got the history, the foundational tech. Now, if someone's looking at this DeFi world today, how do they even start to figure out what's going on? How do you measure the health or activity? What are the key metrics?
That's a really vital question. One of the most common ones you'll hear is total value locked, TVL.
TVL, right. See that everywhere.
You do. It essentially just represents the total dollar value of all the assets people have deposited into the smart contracts of various DeFi protocols. Think of it like a snapshot of the overall size, the liquidity sloshing around the ecosystem.
So higher TVL generally means good things, more trust.
Generally, yes. A higher TVL suggests the protocol's attracted significant capital. That usually points to strong liquidity, good user adoption. And yeah, over time, if a protocol holds a high TVL consistently, it can imply a certain level of security and trustworthiness.
Because it becomes a bigger target.
Exactly. Protocols holding huge sums are honeypots for attackers. Surviving that scrutiny, well, it builds confidence.
But I seem to remember hearing that TVL.
Yeah.
It isn't the whole story. It can be misleading sometimes.
Absolutely right. You have to be careful with TVL. Protocols can sometimes, well, game the system. They might offer really high, but totally unsustainable rewards in their own native tokens just to attract deposits quickly.
Pump up the numbers temporarily.
Precisely. These temporary spikes in TVL might look impressive, but they don't necessarily reflect genuine long-term user commitment or the fundamental strength of the protocol itself. That's why it's really, really crucial to look at TVL trends over time.
Not just a single number.
Exactly. A steady, consistent upward trend. Generally a much better sign than a sudden, crazy surge that might just disappear next week.
Okay, so TVL gives a sense of scale, but look at the trend. What other metrics give us clues about what's happening inside DeFi?
Tracking on-chain flows. That can be super informative.
Meaning where the money is moving.
Yeah, basically, when you see a lot of assets moving off DeFi platforms, like from DEXs or personal wallets to centralized exchanges, CEXs.
Any Coinbase or Binance.
Right. That often signals people are taking profits, maybe converting back to fiat, cashing out. Conversely, when you see big flows moving from those centralized exchanges back onto the blockchain and into DeFi protocols.
That suggests new money coming in.
It can, yeah. It might suggest new capital entering the space, looking for DeFi opportunities. So watching those flows back and forth between the centralized world and the decentralized world gives you a pretty valuable sense of overall market sentiment and activity levels.
That makes sense. Like following the capital flow.
Yeah.
What about the health of the protocols themselves? Are they actually making money?
Yes. Fees and revenue, really important indicators for long-term viability. A protocol needs to actually generate enough fees from its users to cover its costs, right? And ideally, build up a treasury for future development, growth, security.
The standard business stuff, but on-chain.
Kind of. But here's the catch, and it's vital. You have to look beyond just the headline revenue figures. You need to understand the costs of generating that revenue.
How so?
Well, think about those incentives we just mentioned for boosting TVL. Many protocols use their own native tokens as rewards to attract users and liquidity providers. These incentive costs can be huge.
So the revenue might look good, but they're spending a fortune in their own token to get it.
Exactly. If you don't factor in those token emission costs, you can get a misleadingly rosy picture of the protocol's financial performance, real financial health. You got to look at the revenue minus the expenses, including those potentially massive incentive costs.
Got it. So TVL for size and trend, on-chain flows for sentiment, and net fees or actual profit for sustainability. Okay, let's get into where this yield actually comes from. What are the main types of DeFi protocols we need to know about?
Okay, well, Decentralized exchanges, DXs, are absolutely fundamental, a cornerstone. Like we touched on, they've evolved a lot. From those early order book models like Ether Delta.
Which were maybe a bit clunky.
Yeah, they had their limitations. Now, the dominant model is the AMM, the automated market maker. And even within AMMs, you've seen different algorithms pop up designed to be more capital efficient, especially for certain asset pairs like stablecoins. You even see hybrid models now.
Mixing on-chain and off-chain elements.
Yeah, right. Interestingly, though, if you look at the percentage of the total DeFi TVL held by DEXs, it's actually lower in this current cycle compared to the peak back in, say, 2020, 2022.
How's that?
Back then, DEXs hit over $75 billion in TVL, almost 28% of the whole DeFi market. The shift isn't because DEXs are less important. It's more due to innovations within DEXs making them more efficient.
Like what?
Things like concentrated liquidity. Uniswap v3 really pioneered that. It lets liquidity providers be much more precise about the price ranges their capital covers, makes capital work harder. Plus, you have more sophisticated strategies now for managing liquidity, so less capital might be needed overall to facilitate the same amount of trading volume.
Okay. So efficiency gains mean their slice of the TVL pie might shrink, even if they're doing more volume.
Potentially, yeah. The tech's advancing. But in terms of key players, who's leading the pack in DXs right now?
Well, Uniswap is definitely still a dominant force. It's kind of the benchmark.
Why is that, do you think? What makes it stick?
Several things, really. Its permissionless design, anyone can list a token or provide liquidity. The sheer number of integrations it has across the whole DeFi ecosystem. Its code base is generally seen as very robust, well-audited, and it just has a strong network effect. That all leads to what people call stickier TVL compared to maybe some newer DEXs. People trust it.
Okay, so DEXs are a primary place for trading and earning fees. What other big categories are driving DeFi yield?
Lending protocols are another major one. They function, well, in some ways pretty similar to traditional bank lending, but decentralized. Borrowing and lending crypto.
Exactly. Users can earn interest by lending out their crypto assets. Others can borrow those assets, but they usually have to put up collateral, often more crypto, to secure the loan.
Over-collateralized loans, mostly.
Mostly, yeah. It's proven to be a really successful and widely used part of DeFi. Our sources don't dive deep into specific names here, but think of the big established players in that space.
Right. And then there's this thing called liquid staking that seems to be everywhere now. What's the deal with that?
Liquid staking. Yeah. It tackles a basic issue with proof-of-stake blockchains. When you stake your tokens, say your ETH, to help secure the network and earn rewards, those tokens typically get locked up.
Right, you can't use them for anything else.
Exactly. They're illiquid. Liquid staking offers a workaround. You stake your ETH, let's say, through a liquid staking protocol, and in return, they give you a different token, a liquid staking token, or LST, like STETH or EARTH.
And this LST represents my staked ETH.
Precisely. It accrues the staking rewards, but the key thing is it's liquid. You can trade it, use it as collateral in other DeFi protocols, lend it out, farm yield with it, all while still earning the underlying staking reward.
So it unlocks that staked capital, makes it productive again.
That's the idea. And for Ethereum, it's become huge. By the end of 2023, LSTs represented something like 37% of all staked ETH. That's more than was staked through centralized exchanges, more than traditional staking pools. It's the dominant method now.
Wow, 37%. Okay. And building on that idea is restaking. How's that layer on top?
Right, restaking. Eigenlayer is the big name that really pioneered this. It basically lets you take your already staked ETH, or even your LSTs, and repledge that same capital to help secure other protocols or systems.
Secure more things with the same collateral.
Kind of.
Yeah.
These additional protocols are called actively validated services, or AVSs. They might provide things like data availability layers, oracles, bridges, sequencers, services that need their own security guarantees.
Okay.
So, by restaking your ETH or LST to help secure these AVSs, you can earn additional rewards on top of your base staking rewards. Eigenlayer has seen absolutely massive growth. Its TVL is over $15 billion now. Shows huge interest in stacking those yield opportunities.
So you're leveraging the economic security of Ethereum to bootstrap security for other systems.
That's a great way to put it. It's like your neighborhood watch guard your staked ETH, agreeing to also keep an eye on a few other specific houses nearby for some extra pay.
That makes it very clear. It sounds like it's creating a much more interconnected, maybe more capital-efficient system.
Exactly. And restaking is also branching out into cross-chain security ideas. In the Cosmos ecosystem, there's this mesh security concept, letting staked tokens on one chain help secure another. And look at Babylon Protocol, they're working on Bitcoin staking.
Using Bitcoin to secure other chains. How?
The idea is to let Bitcoin holders earn yield by using their BTC's economic weight to secure other proof-of-stake chains or protocols, potentially without even needing to bridge their Bitcoin off its native chain. Still early days, but potentially huge.
Wow.
And just like we have LSTs for liquid staking, we're now seeing liquid restaking tokens, LRTs. Same idea, unlock the liquidity of those restaked assets so they can be used elsewhere in DeFi.
Okay, so this layering is getting pretty complex.
Mm-hmm.
Staking, then liquid staking, then restaking, then liquid restaking. It's like yield generation on yield generation. Looking ahead now, what are some of the really cutting-edge emerging trends in DeFi that you're watching?
Yeah, there's always something new. We're seeing specific yield AM protocols being developed. These are AMMs designed from the ground up to really optimize both liquidity provision and yield generation.
Making it easier to earn?
And more efficient, hopefully. Then you have yield aggregators and abstraction protocols. These are becoming super important. They basically scan across lots of different DeFi protocols to find the best yields and then simplify the process for users to deposit and earn, trying to make DeFi less intimidating, more accessible for, mainstream adoption.
Yeah, that sounds crucial. The user experience can be a lot. What else is bubbling up?
Derivatives DEXs with integrated borrow-lend markets. This is a big one. Derivatives in traditional finance are enormous, right?
Futures, options, yeah, massive.
So we're seeing more sophisticated DX focused on derivatives, but they're also building borrowing and lending features right into the platform. This lets traders leverage up, hedge positions more easily, manage collateral more efficiently, all within DeFi.
Increasing capital efficiency.
Exactly. And things like flash loan vaults and one-click looping are interesting too. They aim to make complex strategies like leveraged yield farming where you borrow and redeposit repeatedly much simpler for regular users to access. Though obviously higher risk often comes with those.
True. And the big one we keep hearing about, tokenization of real-world assets, RWAs. Feels like that could be huge.
It really does. RWA tokenization has the potential to be genuinely transformative. It's about bridging the gap between traditional finance, TradFi, and this new decentralized world.
How does it work?
It involves taking assets that exist off-chain in the real-world fiat currency, real estate, bonds, invoices, art, whatever, and representing them as digital tokens on a blockchain.
Like stablecoin.
Stablecoins are the perfect example. They're the earliest and arguably most successful RWA so far. Tokenized fiat, mainly US dollars, USDT, USDC, DAI. They provide that essential stable unit of account in the volatile crypto world. They dominate the RWA space currently.
Right. But beyond stablecoins, what other RWAs are getting tokenized?
Well, tokenized treasuries saw really significant growth in 2023. As yields in other parts of DeFi maybe cooled off a bit and TradFi interest rates went up, people wanted that low-risk yield from U.S. Treasury bills.
So you can buy a token representing a T-bill?
Sort of. Platforms like Ondo Finance, Franklin Templeton, OpenEden offer these tokens. It's usually not a direct tokenization of the actual T-bill itself, though. More often, the token represents a share in a money market fund that holds those treasuries.
Ah, okay. Important distinction.
Very. And it usually means there's some level of KYC, know your customer involved, unlike much of pure DeFi. But still, the market cap for these tokenized treasuries hit nearly $1 billion by early 2024. Shows real demand.
So bringing traditional regulated assets on-chain, what about slightly riskier stuff?
Yeah, private credit is another fascinating area. We're seeing on-chain protocols trying to facilitate loans, often unsecured to real-world businesses. They assess creditworthiness using maybe alternative data, on-chain history, things like that.
Lending to SMEs via blockchain.
That kind of thing. This sector hit some bumps, saw some defaults back in 2022, but it seems to be recovering. Platforms like Centrifuge, Goldfinch, Makel are active here. Then there's regenerative finance refi, using blockchain for social and environmental good. A key example is tokenizing carbon credits, like the Toucan protocol does, to create more transparent and liquid markets for environmental assets.
Interesting. Using DeFi tools for impact.
Exactly. And of course, tokenization of real estate and goods. Think fractional ownership of property, making it easier to invest in or trade, or tokenizing art, collectibles. Platforms like Realty for property, Courtyard.io for collectibles are exploring this.
It really does sound like DeFi is trying to touch almost every part of the traditional financial system and even beyond. Any other emerging trends catching your eye?
A few more, yeah. The idea of credit based on protocols, building credit scores, or lending limits based purely on someone's on-chain activity and reputation, rather than TradFi scores.
Your DeFi history becomes your credit score.
Potentially. Trade and receivables financing, using tokenization to provide liquidity to businesses against their outstanding invoices, could unlock a lot of working capital. IP fractionalization, breaking down intellectual property rights into tokens for investment or monetization, and the whole concept of programmable ownership.
Programmable ownership.
Yeah, making asset ownership more flexible, more automated. Think real-time adjustments, enhanced transparency, more efficient management baked right into the asset's token. Lots of potential there.
Okay, this is a dizzying amount of innovation, just incredible potential. But let's be realistic. What are the big roadblocks?
Yeah.
Especially for getting large traditional institutions, the big money, comfortable with DeFi.
Yes, the challenges. And they are significant. Regulatory uncertainty is problem number one. Institutions live and breathe regulation. The lack of clear, consistent rules for DeFi in many jurisdictions is a major, major deterrent.
They don't know the rules of the game.
Exactly. Then you have practical things like wallet and access issues, the way individuals manage crypto wallets. That often doesn't meet the security, the operational, the compliance needs of a large institution. They need institutional-grade solutions.
Custody, multi-sig, reporting, all that.
All of that. Then, asset listings and liquidity. Institutions need to deploy serious capital. They need deep liquidity in the assets they want to interact with, especially things like those LSTs we talked about. If liquidity is thin or fragmented across many different platforms, it's inefficient and risky for them.
Makes sense. What else?
Inconsistent incentives. Those short-term, sometimes unpredictable token reward programs we mentioned, they don't really mesh well with the longer-term investment horizons and strategies of most institutions. They need predictability.
No fly-by-night yield farms for the pension funds.
Pretty much. Risk management concerns are huge too. Institutions need robust tools, better insights into the economic risks, smart contract risk, oracle risk, liquidation risk, and just general security concerns before committing large sums.
You mentioned fragmented liquidity.
Yeah, that's a big one too. Liquidity being spread thinly across dozens of DEXs, multiple blockchains. It increases borrowing costs, makes execution worse, and just generally reduces capital efficiency across the board. Institutions hate that kind of friction.
So it's a mix of regulation, tech maturity, market structure issues. Quite a list. Are people working on solutions? What's being done to address these institutional concerns?
Yes, definitely. Progress is being made. We're seeing the development of permissioned protocols or permissioned pools within existing protocols.
Like a walled garden within DeFi?
Sort of. They aim to let regulated entities interact with DeFi applications while still meeting compliance requirements, maybe controlling who can participate, ensuring KYCAM is done. It's a bridge strategy. The growth of cross-chain infrastructure is also vital. Bridges, messaging protocols, anything that makes it easier and safer to move assets between different blockchains is key to unifying that fragmented liquidity.
Connecting the islands.
Exactly. We're also seeing moves towards structured entry for private capital. Things like setting up formal foundation companies or DAOs, decentralized autonomous organizations, but with proper legal and financial professionals involved, creating frameworks that institutions feel more comfortable interacting with.
More familiar structures.
Right. There's also a growing focus on liquidity in key assets. Conscious efforts by protocols and the ecosystem to deepen liquidity, especially in those core assets like ETH LSTs, to make it easier for large players to get in and out without moving the market too much.
Concentrate the liquidity where it matters most for institutions.
Precisely. And finally, just a better understanding and deployment of incentives, proper incentives deployment. Designing reward programs that are transparent, sustainable, and aligned with attracting and keeping that sticky, long-term institutional capital, not just short-term mercenary farmers.
Okay, so it sounds like the DeFi world is actively trying to build those bridges, mature its infrastructure, and generally make itself more palatable for the institutional crowd.
It is. It's an ongoing process for sure.
Well, this has been incredibly insightful, a real deep dive into DeFi yield. We've gone from the pre-Bitcoin history with Nick Szabo,
Way back,
through the foundational tech like Ethereum and AMMs, covered key metrics like TDL and on-chain flows.
and the importance of net revenue.
Right. Then the main protocol types, DXs, lending, liquid staking, the whole restaking evolution, and looked at these fascinating emerging trends, especially RWAs, bridging TradFi and DeFi. And finally, tackled the big challenges and potential solutions for getting institutions involved.
Absolutely. It's clear the pace of innovation is just relentless in this space. That integration of real-world assets, as you said, feels particularly significant. It could genuinely reshape how traditional and decentralized finance interact.
Yeah,
And for our listeners, hopefully this underscores the value of understanding those key metrics, but also being critically aware of their limitations.
definitely. Don't just chase the highest TVL blindly.
Right. And acknowledge that while the potential is massive, there are still ongoing hurdles: regulation, security, usability on the path to mainstream institutional adoption.
So maybe a final thought for everyone listening to chew on. Considering this blistering pace of innovation we've discussed, especially with RWAs coming on chain and staking becoming ever more layered and complex, what kind of completely new financial instruments or systems, things we perhaps can't even properly imagine yet, might emerge in the next few years? And how could they fundamentally challenge or even reshape the traditional finance paradigms we've known for so long?
That's the billion-dollar question, isn't it? A fascinating space to keep watching.
Absolutely. Thanks for joining us for this deep dive.